Welcome to the Deep Dive. Today we're digging into the Q3 2025 earnings call for AvalonBay Communities, AVB.
Right. One of the giants in the REIT world, heavily focused on those coastal markets, the ones that are usually tough to build in.
Exactly. And this call, it was really interesting, kind of a tale of two stories, wasn't it?
It really was. You had the short-term bumps, some operational friction they were pretty open about. They missed their earnings outlook, trimmed guidance.
Which the market did not love.
No, definitely not. But then they spent a lot of time talking about the long game, positioning themselves for what could be a really significant advantage coming up in 2026.
Okay, so let's start with that friction. The stock definitely reacted, right? So I did a 52-week low briefly around the announcement. What were the headline numbers that caused that reaction?
Well, on a GAAP basis, EPS was $2.68. That's up 2.7% year over year, so modest growth.
But for REITs, everyone's really looking at FFO, funds from operations.
That's the one. Core FFO per share came in at $2.75.
Right. The cash flow metric,
Mm-hmm.
excluding things like depreciation, gives you a clearer picture of property performance.
Precisely. And, well, that $2.75 number, that was the issue. It was about 5 cents lower than their previous outlook midpoint.
Okay, 5 cents short. And where did that miss come from primarily?
Mostly from their bread and butter, the same store portfolio. The properties they've owned for a while.
Right, the stabilized assets. That's where you really see the underlying health. So let's break that down. Revenue and expenses there.
Okay, so same-store residential revenue, it only grew 2.3% compared to last year. Kind of a slowdown.
Okay, 2.3% on revenue.
But here's the kicker. Same-store operating expenses jumped 4.6%.
Ouch. 4.6%. So expenses grew way faster than revenue.
Yeah, exactly. And when you net that all out, same-store NOI net operating income, that only grew 1.1%.
Well, 1.1%. For a REIT like AVB, that feels quite low. Expenses basically wiped out the revenue gains.
Pretty much. And management actually broke down that 5-cent FFO miss. They said 3 cents of it came directly from same-store.
3 cents from same-store alone. How did that split between revenue and expenses?
1 cent was lower revenue than expected, and 2 cents came from those higher operating expenses. So it wasn't just softer demand, it was also an expense issue.
Okay, let's tackle revenue first. Why the softness? What did they say?
They pointed to apartment demand being weaker than they'd forecast.
Yeah.
Linked it to slower job growth, general macroeconomic uncertainty, just people feeling a bit cautious.
That uncertainty factor makes sense. Did they mention specific regions where it was worst?
Yeah, they did. They said the rental rate softness really showed up in August and kind of carried through September and October. The weak spots were the Mid-Atlantic, Southern California, specifically LA, and also Denver.
Did they give reasons for those specific spots?
They did offer some granularity. For the Mid-Atlantic, they mentioned the threat of a government shutdown that was really hanging over things in Q3. That always hits the D.C. area demand.
Right, that uncertainty creates immediate hesitation there.
Right.
And L.A.?
For L.A., they were pretty specific, pointed to layoffs in the film and TV industry. They actually cited a number, said film and TV jobs there are down something like 35% compared to 3 years ago.
35%, wow.
Right.
That's huge. That's not just a data point. That affects a whole pool of potential renters.
Absolutely. A major headwind for that market, even for a premium operator like AVB.
Okay, so that's the revenue side. Now back to the expenses, the 2 cents of the miss. What drove that 4.6% jump?
It was a few things. Unfavorable variances in utilities, insurance, employee benefit costs, and repairs and maintenance R&M.
R&M.
Oh.
I remember in the Q&A, they called it hitting a bad streak of higher cost repairs.
Yeah.
That explanation felt a little convenient.
It did sound a bit like that, yeah. Like maybe a run of bad luck. It makes you wonder, was it deferred maintenance catching up? Or maybe staffing issues leading to using more expensive outside contractors. They didn't really elaborate beyond the bad streak comment.
Right, a bit unsatisfying. So with both revenue softer and expenses higher, the guidance cut makes sense. What's the new number?
They trimmed the full year 2025 Core FFO per share guidance. The new midpoint is $11.25.
$11.25.
And that reflects
basically a more cautious outlook for the rest of the year. They lowered the full year same-store revenue growth expectation down to 2.5%. That's a 30 basis point cut. And they nudged up the expense growth forecast slightly to 3.8%.
Okay, so that covers the near-term picture. The miss, the expense pressure, the guidance cut. That explains the stock reaction.
Exactly. But then, like we said, they really pivoted on the call, spent the whole second half laying out why this quarter's issues are less important than their long-term setup.
And a big part of that is the balance sheet, right?
Huge part. They kept emphasizing their financial strength, over $3 billion in liquidity. Plus, they managed to issue $400 million in notes at a pretty good rate, effectively 5.05%. That flexibility is key right now.
And they're actively managing the portfolio, too. Very actively. Sold 6 communities, pocketed nearly $600 million, booked some nice gains, then turned around and bought 3 new properties in places like North Carolina, Florida, Washington, higher growth areas. So pruning and redeploying.
Makes sense. What about returning capital to shareholders? Any buybacks?
Yep. They bought back about $152 million worth of stock in Q3. And importantly, they got authorization for a new $500 million buyback program.
That sends a signal, doesn't it? Management thinks the stock is cheap after that dip.
It certainly suggests confidence in the current valuation, yeah.
But the real centerpiece of the long-term story seemed to be their development pipeline.
Absolutely. That's their big differentiator, they argue. They've got 21 projects under construction right now. It's a $3 billion pipeline.
$3 billion, that's significant.
It is. And they stress that 95% of it is already match funded with capital that costs them less than 5%.
Wow, locking in low-cost capital for future growth. Smart. How are the projects performing?
Apparently quite well. They said current lease-ups are actually doing better than they initially projected. Even mentioned saving about $12,000 per unit on construction costs for some recently finished projects compared to budget. Lower bases, higher potential returns.
So lower costs and potentially higher rents.
Yeah.
What kind of returns are they targeting on future projects?
For the new developments they plan to start in 2026, about $1 billion worth, they're targeting yields in the 6.5% to high 6% range.
Okay, so if their cost of capital is below 5% and they're building to yields above 6.5%, that's a very healthy spread.
A huge spread. That's the engine they believe will drive value.
And this ties directly into their big macro call, the thing they kept hammering home.
Yeah.
The lack of new supply coming in 2026.
This was the absolute core of their bullish case. They predict that in their main established coastal markets, new apartment supply will drop to just 80 basis points, 0.8% of the existing stock in 2026.
80 basis points, that sounds incredibly low.
It is. They specifically said, we haven't seen levels that low since 2012. It's basically a supply cliff, less than half the average of the last decade.
And basic economics says scarcity means pricing power.
Exactly. That supply cliff, combined with the ongoing affordability crisis in housing, that's their argument for a major tailwind.
Right. The affordability gap. They mentioned that too.
Yeah, it reminded everyone that in their key markets, owning the median home costs something like $2,500 more per month than renting the median apartment.
$2,500 a month difference. That's staggering.
And that gap keeps people renting. So if new rental supply dries up in 2026, like they predict, that demand has to go somewhere, presumably to their existing properties.
Okay, so we have these two competing narratives, the immediate Q3 pain in the miss, the expenses, versus this potential 2026 structural advantage based on supply scarcity.
That's the tension. Which brings us to our next segment.
Right, time to synthesize this. And just a reminder to everyone listening, this is not financial advice. We're purely discussing a trade idea based on the call commentary, exploring the possibilities.
The whole risk-reward here really boils down to one question. Can AVB manage through this near-term operational softness until that 2026 supply crunch really bites?
So our thesis, based purely on their commentary, is what we're calling the 80 basis point supply arbitrage. The idea is that the stock is likely priced in the guidance cut already. So the pitch would be a leveraged long position in AVB. The bet is on their development platform delivering those high spread projects, and crucially on that 2026 supply cliff in their core markets, leading to a significant re-rating of the stock.
Okay, a long position. But what about those near-term risks? The softness in places like Denver they mentioned.
Good point. Management themselves called out some markets as being littered with supply. So to potentially mitigate that regional risk, the structure could be a pair trade.
Meaning
you go long AVB, betting on that coastal scarcity premium materializing. But at the same time, you short a competitor REIT that's heavily exposed to those high supply, maybe Sunbelt or non-coastal markets.
Okay. So you're betting not just on AVB doing well, but on the difference in performance between AVB and those oversupplied market players becoming really pronounced by late 2025 or early 2026.
Exactly. It's a bet that AVB's specific market positioning And that projected 80 basis point supply number will win out over the current operational headwinds.
A play on strategic focus and capital discipline versus near-term noise, really anchored by that specific macro forecast for 2026 supply.
So wrapping this up, what does it mean for you listening? Well, the immediate story, the thing driving the stock now, seems to be digesting that Q3 expense pressure and the guidance cut.
Right, hence the recent stock weakness. But the medium-term story, the one management spent so much time on, is all about their balance sheet strength and, most importantly, that massive projected drop-off in new supply in their key markets come 2026.
That scarcity argument is powerful. But there's always a but, isn't there?
Always. And one interesting point came up in the Q&A. Management briefly mentioned that cities are increasingly offering incentives for adaptive reuse projects, specifically converting old office buildings into apartments.
Office to resi conversions, that's been talked about a lot.
Exactly. So here's the final thought for you to consider. How quickly could this newly incentivized, maybe unexpected urban supply actually come online? Could enough conversions happen fast enough to disrupt that suburban and coastal scarcity narrative AVB is banking on for 2026 and beyond?
An interesting wrinkle to track, something to definitely mull over. Thanks for tuning into The Deep Dive.